Good morning, everyone. We are live here at the set. Quite a lot going on. We've got, I think, a pretty good show for today. As you folks know, we do these on Monday and Friday, and Mitch and I were both up burning the oil last night. I got 2 hours.
To say the least.
Yeah, I got 2 hours on him, and so I was equaled his time up, but with the time lag. But yeah, we were up watching this thing, watching Europe last night. We're having shades of 2011 in Europe a little bit. This Portugal thing. We'll talk about a couple of things before we get into the technical aspect of the show. But we talk about a couple of things that is occurring here, which I think is really important to understand. Is that all of a sudden, and this is the way it works, folks, and there's not always a reason for every movement. Mitch and I were talking about this yesterday, and there's not a reason for every time the market does it. Well, what caused that to happen? Well, what caused it was usually more sellers or more buyers than there was on the other side of the equation, which will push the markets around. But the realities is that market sentiment is an emotional thing, and that's the thing that through a lot of different processes and technicals, primarily in technical analysis, depends on that emotion to show up in the markets, whether it's in an extreme stretch situation or whether it's just maybe even complacency. And those of you that watch the show all the time, we've been talking about this trading range we've been in. We've been locked in that. Well, we're no longer locked in it. We are out of it, and I don't know, what do you call it? The dog's out of the pen. He's running. He got loose, and he hasn't turned back yet. We're seeing further decline. We're another 104 down. We're down 400 now on the Dow Jones, and probably not even two sessions. About one session. The last part of yesterday, we saw some acceleration on the downside. Now we're continuing to see this follow through, and this is one of the reasons why we sent out some of the emails that we did, and trying to arouse some other folks to join us in on the show today, is that there is a significant situation occurred yesterday. A lot of times I'll say one day doesn't make a trend, but we're going to talk about why yesterday actually had a substantial impact on market sentiment as well as the technical trends that are out there. So a couple things that we've seen this morning. Unemployment, I guess, upticked a little bit, but supposedly that's good. You couldn't tell anybody trading this market that was good. U6 unemployment is 12.2. I think it was up like 0.2. That's actually been a more volatile, probably more, I guess, real. The typical headline that you see has been declining, I think, for 6 months in a row or something. Little downticks, 0.1 or whatever, or it's flat. But in general, the trend has been down. In the U6, it's been much more volatile, about a 0.4 swings up and down either way. So it's, there's a lot more going on there. So, Mitch, what were some of the other things that we were talking about? What was the jobs or what?
So the non-farm payrolls expected was 233, came in at 209, so we missed on that. As you already mentioned, the unemployment rate spiked up because more people entered the workforce. So this is one of those situations where the bad news is actually good news, I guess. Other thing that came out today was the PMI manufacturing index. That was a slight miss. Consensus was 56. It actually came in at 55.8. Sentiment did hit expectations, slightly beat it. They were expecting 81.5. It actually came in at 81.8. And then another story today that we beat expectations was with the ISM manufacturing index. Consensus was at 56, came in at 57.1. So, I mean, those are really the big stories. Earlier this week, yesterday, we mentioned the fact that the GDP came in. They were expecting 3, and it came in at 4. I mean, that's a pretty nice beat. And then they also updated the prior numbers from 2.9, a loss of 2.9 to a loss of only 2.1%. So another 1 percentage point swing on that.
Yeah,
so,
but like I said yesterday, that 4.0 GDP was about as real as the minus 2.9 in the first quarter. It's pretty. Yeah. All of these numbers, by the way, the employment numbers, the job numbers, supposedly the accuracy is plus or minus 100,000. I mean, it's not, that's bigger than I don't know. You'd have to have some kind of bomb to get that big of area. I mean, it's just not accurate at all. Market participants look at the number and they watch it. That's why you see all these revisions. 30, 40, 50, 80,000. That's why, because it's a real volatile number. And there's really not a lot here. There's very few of these government reports that have any real accuracy as far as it goes. But because they're always being adjusted. There's seasonal adjustments. There's all kinds of stuff. So, but the markets look at it, and that's what they're responding to today. So, yeah, we were bouncing here a second ago. The Dow Jones was down 96. It's now flipped around. It's now all the way back down to what is this? 109 down. So 1654.16 right now in the Dow Jones. A couple of things that we're going to cover today, and I want to kind of set up, I guess, the general thoughts that we had overnight and what I did and looking at things. Obviously, in theory, yesterday, if you were looking around for what might have caused this thing, maybe it was Argentina's default. That it was interesting, and I couldn't find a good chart to show you folks. The Argentina market, the day they announced that they were missing the payment, spiked up. It went straight up, and everybody, all the commentaries, it doesn't matter, it's just not a big deal. Well, by the time that the next day happened, and it all reversed, the spike was reversed, plus about another 1 3/4% off of that, and about a 4% turnaround. And you started to see that the Portugal, what is it, Banco Santa something, whatever, that thing is upside down, sideways, everything. And now the real test for the ECB and for the European community is if this bank needs another magic word, bailout, who's going to do it? Are they really committed to this? And if there's any hesitance, that could set even a further negative market sentiment in Europe, and that in itself could be one of the things that happens. So there's several things that I'm going to discuss today. I'm going to go ahead and Mitch, I don't know if you have anything else right away.
No, let's dig into the charts.
All right, so bringing up right now, matter of fact, I'm going to take off the trading system for a moment. But one of the things that this is the weekly graph of S&P, and what we're seeing is a massive reversal pattern that occurred yesterday. Also, we're seeing, I put on, there's a 21-week cycle that has been hitting fairly good at several points, which hit about 2 or 3 weeks ago. The expectations have been based on PPMs and et cetera, were that the trends were intact pretty well, and we would see this sideways trend resolve itself to the upside. There were some new objectives that came out. If you recall, the original objective going all the way back to 2011 was 1915, was the number that I talked about in annual reports that I wrote in 2011-12, and it kind of continued through the 2013. I was looking at some of those reports. And that was a big number, and then it was revised to the 1964 to 1974 level. We hit 1991. There was a couple little numbers out of the BPM Fibonacci projection tool that came out that was suggesting that we would go a little higher, but everything was clustering on a number of charts right at this 1980 to 2030 was the mark. So I'm going to bring up and see if I can get this blowing up enough that we can see this. And let me stretch this out a little bit so you can see this. But the bar that happened yesterday, 2 days ago, we were trading at 1978, and the high was 1991. We were one good session from being an all-time new high again. And when we came in yesterday morning, we came in weaker, and we started to just cut through every support number, and it just grew on itself as it started to unfold. And we ended up trading all the way down to 1930 and change, and finishing the session there, which was a monthly close yesterday. And the significance of this is huge, because if you're a technician, there's a couple of things you look for. and one of them is called a key reversal. And a key reversal has to happen even at extreme new lows in the pattern or extreme highs. In this case, in the month of July, we made an all-time new high, and then we closed down at the low of the month, and we were just short of penetrating through the lows of last month. Now, we just came really close to it a minute ago, 1916.37. I'll verify this number in a minute, but I believe last month's low was 1915 and change. Let's take a quick look at that, or not last month, but it'd be a June low. Yeah, 1915.98. So we just printed a second ago 1916.37. So if we take out that low, now we're starting to see some things that are even more significant. As you folks know, a lot of our strategies have been moving to cash over the last 6 weeks, as we've been, even though the market's been playing around with these new highs, we've actually saw, I think, a net. Mitch can talk about that a little bit when he comes back on. But we have seen a net seller. Most of the global strategies are at 40%, and when the daily ETF DI, or the old daily global equity, is at 20% invested, I believe, at this time. Isn't that right, Mitch?
Well, the entire database, when you actually look at it,
on
is
the
only
database.
20%
Okay.
invested when it comes to all the 18,000 securities on a daily basis.
Okay,
So,
yeah. So having said that's an interesting number, because usually when you get down around that 20% level, you start to get at an extreme for that number. So we'll have to take a look at that. I misunderstood. We were talking offline before the show what that was really meaning. But the bottom line is we had a key reversal on a monthly basis, not on a weekly or a daily basis. This is the big daddy of charts, which is the long-term chart. And I've talked about a couple things that was happening, and those, like I said, your regular watchers, you're going to know this number, and it's on my screen right now. I told you when the PPM won on a monthly basis. Let me get out of the way. Let me just put it up on the screen here so you can see it. When the PPM 1 got below 100, it would be a sign that we have started the process of the topping process on a big scale and a big stream of things, and it is 0.87. And just 2 days ago, that was 140 or 138. It had started to go down, and now we are seeing that the PPM1 at 0.87 and PPM2 at 0.40. Now we're seeing the convergence of the two averages, and part of the process of anything, if you look at put 2 moving averages, 3 moving averages on a chart, you'll see that they converge and then they roll through each other. The first process of every top is that convergence. So we're seeing a convergence on a big scale. The trend is getting close to being broken. The magic number on this chart, I'm just trying to find it, is it's all the way down. That 10 period moving average on a monthly basis is 1878.51. It just changed, and it is it's a ways below the market yet. So that is still going to act as support, and that will probably be the first line of defense for this market, depending on whether we can get through this 1915 level. We'll have to see how. We're going to go through some of the short-term charts here. So usually what we do on this show is we're focused on the first segment, first 15-20 minutes of the show is on the S&P and trend movements. We're going to extend that today because there's there's so much that's come to focus and that has been out there, but it hasn't been worth talking about, that needs to be discussed. But this reversal is very big, and we've already started the month of August exceeding the lows of the month of July. Since we closed on a low, that was pretty easy, and we're down today. But those are the kind of patterns that you start to see as these big reversals happen. So we've already made a new low. So all we're going to have to do as we come into the end of August is that we're going to need to see just a close under 1930, which would be the July close. As you know, obviously it's August 1st, so we got a little ways to go. But that's going to be the focus on whether we can close lower. We've already made a lower low. Chances of making a higher high than we did in July is probably 30 or 40%. we'll see what kind of patterns emerge as we go through the month, and obviously be talking about that on commentary as well as all the other venues on Market Thunder and other things that we distribute throughout the month as far as research goes. And the bottom line is we've got a big event here, and when we go back over to the weekly graph here, the weekly graph, you see a huge reversal pattern here, and two things are happening. We are right on the, bring up the numbers again, we're right on the, we're at 1908.31 is the 21 period moving average. We are through the 1956.22 number. If you recall 2 days in commentary ago, that was a key number on the sheets at that 1956. We took that out yesterday, and it was over. It was completely over. What was that scene from Aliens when he's going, game over?
Game over, man. Game over.
It's pretty funny. So, that's what just snapped in my head. Not sure why, but that's what it was like. I mean, everybody's selling. And yesterday is another interesting day from the standpoint it was sell everything day. The bonds,
Yeah.
the bonds were sold, gold was sold, everything was sold. We're seeing a little bit of a bounce in the bonds today. We'll talk about all that here shortly, but that was big, yeah. But it was game over for sure.
Well, the funny thing is, everybody was talking about Argentina's default, but if you actually looked at the markets, financials were down substantially. Obviously the domestic countries that did have an exposure there to it. But it was actually the energy sector that had the largest losses of the day yesterday, and that still remains true today. So I mean, this is a widespread issue that's taking place. It's not just this one little pocket.
Yeah, and so good news is a good portion of our portfolios were in cash. Some of you were wondering why. Now you know.
Yeah.
And that's how. When you're looking at when you take something like VPM and you've got the ability to watch 18,000 some odd symbols, and you start to see that. And as Mitch said, we'll bring it up. We'll bring VPM up here shortly, and maybe look at that. But the database on the daily is down to 20%. So there must have been a massive amount of selling today, I'm sure.
Yeah, and I did pull up the Global Equity 2 daily, which is all the normal global equity positions using only the daily models. We sold out of the last position on Wednesday of all days.
So we're 100% cash.
We're 100% flat, or not, out of equities.
Yeah, and when you get in these volatilities modes, we talked about this. And speaking of 2011, that's when that strategy was developed because of the volatility that we were seeing when we were seeing 8 and 10 and 14% swings in the market randomly. It was able to respond to that and did a really good job of capturing that volatility. Since then, 2012 and beyond, markets have trended very nicely and are still in this trend. By the way, we're talking about right now, a 2.5%, maybe 3% loss off of the high. Is that the end of the world? No, but like I said, the fact that we got this action on when we got it was pretty significant. I had played out in commentary about the significance of staying over 1964.10, and we obviously didn't do that. We closed at 1930, substantially below that. So there were some key numbers that were important for the month of August and beyond that were violated yesterday, because while the trend has been in a very robust mode, it is also very delicate, some of the configurations when you're looking at bar chart analysis and other things that were real critical that it remained intact from the standpoint of what was going on there. So there's a chart. I'm not sure where I want to go with this thing next because there's just so much. Maybe this is a good perspective chart anyway. The chart I put up here right now, and it's kind of peeking in between Mitch and I on the screen, is the Dow Jones from 1925, the current. And I wish I had a chart. I've got a article I read on it looks like the tulip craze, and it's almost vertical. This is a classic bubble formation that we're seeing, and you can see from the spike low that's over here. I'll get the my whiteboard out here. If you look at the spike low, that occurred in '09 to what we've done here. So you get this low here. If you look at this entire sequence has been straight up. But what's more interesting, on a long-term basis, if you're an Elliott wave guy, you've got some pretty interesting patterns. And this pattern I'm drawing in right now is been considered to be one of these bugle formations. And this is a giant one because it runs. This is about a 35-year pattern that's unfolded. I talked about this in the annual report, and if you don't have access to the annual report and you're online here, let us know. If you drop us an email to support at VPM Partners, we'd be glad to send you one of our annual reports. You can see some of this work, because this was discussed in detail, that this particular situation is the final climax of this rally. There is nowhere to go, and from an Elliott wave standpoint, I'm going to clean a couple of these arrows up here. Well, let me do some of them. But the bottom line is that this pattern here is the most significant, which is that bugle pattern. And when this is a fifth wave, so when you get looking at the pattern, the fifth wave pattern, some people can say it's hocus pocus, whatever you want. I've spent my entire 35-year career in doing this, and I can tell you that this is significant. And if you would have known me in the 80s and 90s and even in early 2000s, that I was still the optimist that the market was going to go on. We have now hit probably a critical mass from a debt standpoint, sovereign, corporate, all kinds of stuff. There's some things that we're going to discuss today that will talk about some of the corporate mess that's been going on, and particularly in the small cap segment and the mid cap segment of the stock market. And we'll talk a little bit about what Bernanke and Yellen and what they're continuing here, which is going to could actually be pretty disastrous in the end. But what happens on these patterns, typically what will happen is you will get a pattern, and the rule in Elliott wave is once you put a 5-wave pattern in, usually you will decline to a wave 4 of the previous degree. I'm going to draw an arrow up. I don't have a text tool to put the numbers on the screen for you, but this arrow up underneath there is wave 4 of previous degree, and in this case was 6,000 roughly. I don't know what the exact number of the low was there. I could bring it up. I just can't get there right now. But that low is where the market typically will retrace back to once the fifth wave is considered. Now, you're looking at 7-year rally that it did that in. You're also looking at a 30-year pattern. So that means it's not going to happen tomorrow. It's going to take multiple years, but this is probably the peak of these markets for some time, I would expect. It's pretty much, this chart gives you probably the best view of what's going on in the world, and all of us know that the markets have went much higher than we thought they would go. I thought they would get to the 1905, 1915 level, and we basically exceeded that, but now we're starting to see, once market sentiment turns, this thing's like turning a giant boat around. It doesn't turn very quick once we have it. So we've started quite a bit of stuff we're going there. So anyway, this chart is big. It tells us that there's a potential top here, major top. What likely is to happen is, and I'll set that up on the S&P here in a minute, is what we'll talk about in a little bit here. Let's go to one of the other things I've been discussing a lot for those the regular watchers. I'm going to need to get Mitch is still on the screen. I'm going to get both of us off the screen for this. The bottom line is what we've got here. This is the EFA versus the S&P, and I've been telling you for weeks, almost maybe a month and a half now. I think we've been doing this show for I think this is going in our 4th month, isn't that right, Mitch? I think this is number
Sounds about
4.
right, yeah.
Yeah. So, and we were doing 3 a week of Market Thunder. Just so many folks were on vacation, except for us, right, Mitch? We're still here. So we backed it to a beginning of the week and the end of the week review, and that's working out okay. I kind of wanted to. It would have been nice to do something on Wednesday. We did do that impromptu session yesterday at the close to kind of give you some perspective. But this chart is finally seen. We've seen these little blips before. This is the chart that you want to watch, and I have both the EFA as well as the EEM, and it's interesting because I've said this graph here. I just drew a line down. This has been a trend. That's from '09 you're looking at. This is a long-term chart here. So this is from 2009 to current. The U.S. market has been outperforming the Europe, basically the EFA, which is kind of a European, continental European for the most part. And so we've seen this pattern, and we have seen in the past, where I just drew a couple of these arrows here, that we've seen the Europeans, and we've seen some of the same pattern as on the emerging markets we'll look at in a second, has been unfolding. But ultimately, this was the trade of the century, actually, to be long the U.S., short the EFA. This thing will get unwound. There's a lot of money on this thing. So what that tells you is the cash flow has been going from there, and even though, let's say, Europe is emerging with problems right now, that doesn't mean that the markets are not capable of, I guess, that the U.S. can't underperform, even though, let's say, the European market is going down. They may not be going down as fast as we are, and this spread still works. So both markets can go down, but the point differential is what the play is here. And there's a lot to be reversed. And I guess if you went from 120 to 80, which would be back at this old top here, that would be a huge reversal. And most likely, what that would show, there'd be some other things going on here. Well, the economics continue to more or less look okay. There's some underlying things here in the U.S. going on. It's interesting here in Scottsdale, Phoenix metro area. We were ground zero in the housing crisis, and I was talking to an architect yesterday that was telling me there's an area down in Phoenix proper that they're ripping houses down, and they can't build them fast enough. There are 250 and under houses down there, and mostly tract style houses, but there's a frenzy going on right now. He said it feels like '06 almost, but it can't. In that 250 and under market, there's plenty of money available. In the higher end luxury market, up when you get to North Scottsdale and beyond, it's a complete opposite story. There's all kinds of inventory, all types of lots of houses on the street. Just driving into my place, there's 4 houses back to back to back, all for sale right now. And it's just that the inventory on the higher end of the market is much different than on the low end market. So anyway, so real estate got whacked the other day from was it down -8 or something, Mitch, on the new home sales, I think it was. But anyway, there's a lot of stuff that's going on, and for the most part, what we're talking about today is a shift in market sentiment, and that is really what you have to watch out for. Let's see if I can get back on track. I'll show you the EEM chart. It's actually looks, it's not quite as strong, but it is definitely seeing the same type of pattern that we're looking at on the EFA chart there.
Yeah, the pending home sales was down 1.1% earlier this week, if that's what you're referring to.
Yeah.
One of the other things, going back to those spread charts, didn't get a chance to mention, but that's a great story right there for anybody that uses the diversified modern portfolio theory way of investing. Those advisors have been seeing significant underperformance versus the S&P 500, and that's the story right there. Anytime that you dip your toes into a market that isn't keeping up with something like the S&P 500,
Yeah.
when it comes to, if that's your chosen benchmark, you're using an asset that has no real direct correlation to the S&P 500.
Right.
You're going to be significantly underperforming, and that's the story right there.
Yeah, and that's the stuff that we
international components.
Yeah, and that's the stuff that we sold as well. Was those international components, EFA and EEM. We've been out of those things in the global strategies because they just haven't been adding any value. So, and up to 4 days ago, we were still making new highs on this market. So once again, while we're down a bit, we're actually bounced off of that key low a little bit. We're up about 500 points on the S&P. We're at 1920.61. We got to 16 and change. I forget the exact number. It was there on the screen. 1680 or something, just above that monthly low of 2 months ago of the June low. So that's going to be a real key number. You're probably, those of you reading commentary and what have you, that's going to be a big element to watch for. I brought up the 24-hour stocks or futures charts here, and I want to expand this 5-minute chart. You can see that this was overnight, so this was last evening. We see the sell-off in the middle of the night. It hit the lows around 3 a.m. and this is my time. This is Pacific time, so about 6 a.m. New York. And we've seen this thing just kind of rally up, and then around 7 o'clock, which is after the unemployment, and now we've seen it retest these lows. The cycles that are a bit off right now. These things coming in and out of favor right now. This is a 5-minute chart, which is running 24 hours. And this other chart that I'm going to bring up, you'll see is more significant. We just had, this coming hour will be a potential cycle low coming in for this hourly graph. Now that would suggest that we're likely to see some recovery as we come into the end of the day. And I like to talk about that when we're doing these shows each time, is what the close is likely to look like. If we hold these lows that we've seen right now, and we can get start to firm up a little bit, then this thing should move higher into the close, and higher would be just a recovery in prices. Who knows? Maybe we've seen it before. We're down these numbers and we close positive on the session. We have taken out on the commentary. I talked about 1925.50 as a key number for it to be a positive day. That's been taken out. We've traded through S2, which is a support 2 at 1970. That's been penetrated. And we've been down almost to S3, which was 1913.90. So we've seen all of these challenges for the support on the daily ranges today. And the 3-day range indicator went from about 1560 all the way to 2715 last night. So I've been talking about volatility increasing. We've definitely seen that. And if we go over to, I believe it's this chart here, you can see here we have the VIX now at 17.25. It was interesting. I was watching some Squawk Box Europe last night for a while, and they were convinced that you shouldn't be buying the VIX. So I would say probably buy the VIX. These guys aren't really good. They're commentators, and it's funny. One of the guys there just hates technical analysis, and anyway. So, but that's one of the things that we have as far as we've seen a spike in this range. We are getting close to the highest ranges. We saw a spike like this and the last time we declined, but this one is more significant. We've got we've broken through. I'll bring this up a little bit. We've broken through the let me just get it up here. The 10-period moving average I talked about is 1954.31. We've gotten way through that, and then now this thing updates dynamically all the time, and we're looking at 1906.33. That number just a little bit ago is 1908.61. So we're seeing this thing move around a little bit because these charts open are actually dynamic from the standpoint of updating intraday tick by tick. You'll see some of the values sometimes on these screens will actually change when you have some of the values on the screen here, like I've got it here. I've got it in a little ways in my way. But anyway, so that the VIX is up, everything's up as far as that goes. and we're seeing, like I said, all of the elements there. You can see this is the 1 minute graph, futures again. These are the E-mini contract, and you can see right now we traded 10.25 low. We're now 14 even, and it looks like it's stabilizing in this range after printing down. We'll see how this goes, and by the end of the show we'll come back and review this. So, Mitch, we usually do stock of the day at this point. Oh, one thing I do want to talk about here. I want to go back and let's take a look at the interest rates real quick here. And the 10-year is down back to 249. We spiked to 260 something yesterday. So all of the let me see if I can get this to come up here. All of the flight. I guess we're getting a flight to quality today on the follow through. You're seeing some buying back into bonds. Yesterday they didn't want anything to do with them, and they did spike it up here. Let me see. I've got to link this chart, just so here we go. Get the wrong chart up. You can see just this is a daily graph of the 10-year. We got the 269 high 261.4. You see the reversal, the spike and reversal, and we're right back into the range, and we've been running about 240 or so on 245 for quite a few days down here in this little cluster, and we're back into that range again. So definitely some probably flight to quality. There's some interest in the bonds, and maybe that had a lot to do with most of the news out of the both Argentina as well as the situation there in the bank refunding in Portugal. The other thing that happened overnight is the DAX index, which is a German indice, actually closed below its 40-week moving average and its 200-day moving average for the first time in 2 years. So we're definitely seeing all types of shifts from a technical standpoint of things that are significant across the planet. So, but yeah, so this I don't see anything here. Let's go back and look at a weekly graph here. And the weekly graph is actually got us to where there's still some we're minus 0.19 on ppm1. I'm in front of some of this, so minus 55 on ppm2, which tells us there's a pretty decent downtrend in place on these interest rates right now. So the expectation of higher rates is not happening, and I think some of this international stuff that's going on. There's still also in the background. There's I don't know if they said I think they're trying to do a ceasefire, but there's a ground assault going on in Gaza and the Ukraine situation there as far as geopolitical stuff. Don't think somehow that stuff has already moved to page 40. But there are some forces on the interest rates to keep this thing down. So I think I'm probably done there. And a couple of things that on this interest rate run, I would like to talk about real quick. Mitch, we had some stats we were looking at earlier, and to come back in on we're back on the New York Stock Exchange. Anyway, but the one of the things that we're looking at, and I wanted to address, is that what the Federal Reserve has been doing by keeping these rates by zero. Most of you, since our customers are advisors, have the zeal and this willing to take more risks to grab onto to get some yield for your customers. The perception is that the only way you can make money for customers and is without limited risk anyway, that's the theory, is by utilizing bonds. And the word junk has not scared many of you. It always scares me. I don't know why, but we have seen what's happened with the small cap index and the large cap is the entire rally, and maybe even in the large cap, has been financed. So otherwise, you want to look at a bubble. I believe the stock market is getting around $21 trillion valuation right now. That's really, really big. The bond market is like, I was trying to find the number. I did find, let's see, I think I've got some stats here if I can find them. I did find some corporate numbers out there. There's this is from the Fed, 5.9 trillion in debt right now on the books of corporations, and that has been borrowed, the current borrowing. If interest rates do go up, right now I just talked about they're not, at least from a Treasury viewpoint, they're not, but we're seeing some shifts in, I think we're going to bring up LQD and JNK, right? That's junk, right,
Yep.
Mitch? Yeah. But what's happening from this standpoint is all of these companies have been financed to expand their balance sheets and to finance their businesses and expansion. So if interest rates start to move higher, which the whole taper thing is supposed to come off in October, as we come into 2015 and beyond, if these rates start to tick up, if you can start to get yields, think about this for those of you that have bought some of this stuff. I'm not saying it's wrong. It's worked actually, so I'm not saying it hasn't worked. What I'm saying is at some stage there is a lot more risk in this paper that's out there. But if you start to be able to see less risky paper out there, you're probably going to migrate to that paper and the junk paper, and the ability for these corporations to finance at a reasonable rate is going to change as it goes. So let's say the first element would be to probably take away some of the earnings potential for these companies, and if you could set the tone for where they just couldn't even get money because the people that have been willing to give them money will not be as willing, especially on the lower end of the food chain when it comes to financing these companies. So there is a tremendous amount of risk on the small and mid-cap companies that will be challenged to get this. The larger cap companies have a much different structure in how they're set up. Supposedly 2015, so this is a number to watch. There's almost, the number I saw was 3.2 trillion of that 5.6 needs to be rolled over. So when 2009 and 10, a lot of 3 and 5 year paper has been issued, and that's going to have to be refinanced and rolled over. Maybe on top of that, maybe there's some new money to be to keep the balance sheets growing. So it's very, very possible. We haven't really brought it up, but it's very possible that the risks that we're seeing in the Russell and those type of things are related to that. So let's go back to screen here and see if we can.
Yeah, in regards to that junk, the junk bonds, we do have a high yield portfolio that right now is 100% invested. It's comprised of 5 different high yield bond funds. All of those are long, and I did just double check. Most of these positions, we're not quite at their average duration, but we're maybe a couple months out. That should put us right towards around October, November when we hit the average duration on these positions.
So do we have that on dashboard by chance?
I'm not sure if it's on the dashboard for the trade impact. It will be after this weekend, though.
Okay. Yeah, so I'm just curious on those durations on some of those corporate bonds. But yeah, so the point is these are not things that are happening today. The fact that we had a reversal and we've seen some follow through today on the stock market is significant, but these are events that are starting to unfold that it's very possible, and I'm going to put a 60% probability that we have seen the top of the sequence. There was some new numbers were generated, I think 2 weeks ago out of the VPM projection tool, and that was not. It was 2130 and 2190, which was another 4 or 5% on the upside is all. And in the end, what we're down to is splitting the hairs, trying to grab the last 2, 3, 4, 5%, and the risk levels continue to go up from the standpoint of the overall market conditions that keep happening. And like I said, on looking at that monthly chart, we finally have that first sign that the market is starting the topping process. So typically what we'll see is the market will decline maybe down to that 10-month moving average, which was 1885-ish or so, and then it bounces off there and rallies all the way back and fails. The number that was everywhere for days was the 1985-60 level. We traded above it one time at 91 and change, and then but we couldn't close above it. We've never got to close above that number, and it just especially on a weekly basis where it really matters, it's just been elusive, and now that's not even part of the conversation anymore at trading at 15. That is not part of the conversation. Just not there anymore. So the bottom line is that's what is occurring there. So let's try to look at LQD and take a look at what we're seeing here. This is interesting, I think, but I'm going to go to a very long-term graph. When I was looking at this is a classic. I actually have some work that I did last night. The highs on this LQD was 123.20. The first spike low that you see here, let me put these lines on the graph real quick, see, make sure Mitch and I are on the way we are. And this market's already started to roll over. Okay, I think we have a long position right now. Mitch, maybe we'll take a look.
1.2 weekly is what we're using. Yeah, we are along that since October of last year, October 28th.
Yeah, so which makes sense. So here's the pattern that I saw. This high here is what I'm talking about, and then to this decline here, and now we're seeing this move. And I'm going to draw some stuff. Hopefully this makes sense to everyone. But this pattern, we still have positive ppm 1-2. I'm behind it, but it's ppm 1 is 0.31, which is trend mode. Anything over 0.25 is trend mode. ppm 2 is 0.14, minus 0.14, but then a positive on the longer term. So you got a mixed situation there from a trend view standpoint. But what I saw was is that this move here, you would see a stair step down, and you'd start to get a retracement of this entire 2009, 08-09 scenario. If you remember, LQD was that was a huge number. I think that's in our all-weather mutual fund or one of those, maybe in the one of our all-weather ETF mode. But this thing was way down. It had went from like 110 down to like 60. I'll bring up the number in a minute when I'm on my whiteboard. I can't get the values right now. But this pattern is very likely to happen, and it may have a lot to do with the conversation I was just having about the short-term interest rates and what's going on with these patterns and what's going on fundamentally in the backdrop. And one of the things that is interesting about the markets, having done this for nearly 35 years, one of the interesting things is logic doesn't always come into play, and events that the market thinks has to happen to cause these things actually don't have to happen. They can happen in the mind of the participants. So I always quote this, but a guy I met out of the bean pit in 1979 in Chicago Board of Trade told me, he goes, the prices of beans are not made in the fields, they're made in the minds of men. So it's the market sentiment, what people think they're worth is what they're worth. He said, you look at fundamentals all day long, you can look at returns and all that stuff. I mean, it doesn't matter, and in the end, it matters what the perception is of the market sentiment. If people want to own it, they'll own it. The valuations are very dynamic relative to the participants, and that was way back when in 1979. An average day on the New York Stock Exchange was about 40 million shares. We did that in a nanosecond this morning. So the markets have been have expanded to places where everybody has one of these, my little mouse, and you can click and trade. And there's a lot of activity goes on in the markets every day that never used to happen. And the dynamics that we've seen, everything from the flash crash to melt ups, meltdowns. Yesterday it was a frenzy, and a lot of these devices were clicking pretty heavy throughout the session yesterday, and they're kind of continuing. We're so down 103 on the Dow Jones. But this scenario on LQD, the target, so 123 high, the low 110.73, and then this rebound back around. We went up to about, I've got 120.13 was the high. We're now 118.77 on the screen here. The target to the downside for this pattern is 107.66, about a 10% decline in these assets. And then you've got another a 0.33% retracement of the entire move from the lows of '08 to the highs at that 123 is 107.25. And the Fibonacci objective that is being generated off of some of the tools that I have are pushing 107.66. So there's a cluster 107.66 to 25. So I suspect, depending on how this thing trades, that maybe we'll let that trade go that we have on. What are we profitable on that trade right now?
Yeah, we're up just shy of 3%.
Okay.
We got in at 115.
Okay.
So that doesn't account for
And that's a
today's.
total return symbol, right? That we
Correct.
have. Yeah.
No, I'm sorry. This is an ETF, so that's just price return. So that doesn't count any dividends.
Okay. Okay. So yeah. So some of there's probably a little better payout than that. So the bottom line is, this is a scenario, and I do. Those of you knowing me for a long time, I've always done this. I do what I call reverse fundamentals. So I look at the charts. The charts tell me this is going to happen. So what could cause that to happen? What kind of scenarios are out there? What kind of events are lurking in the background that could cause those shifts and movement to happen? And if you go back to 2008, those of you who were hanging around me in '08, it was pretty obvious some of those shifts and some of the targets and things we had. We had a target of, I think, of 600 and something on the S&P, and it went to the magic 666.
666.
And turn around there, but that projection had come out way after the Bear Stearns debacle, and actually came out of a February price pattern that was out there. So it was about a better part of a year ahead of time in looking at that price objective. So this is also a weekly graph. So what's happening here, this is not something that's happening overnight, but over the course of the next 2-3 quarters, which gets us in ultimately to the 2015, and we'll know a lot more about interest rates at that point in time and what's going to happen. And I just have to say this, I meant to say it earlier, but every time there's a change in the Fed, there seems to be a big major debacle of some sort. It happened, 1987 crash was literally, I think it was 3 to 4 months after Greenspan took over. Volcker stepped out, Greenspan came in, and then of course Bernanke and all these folks around the .com, and then of course we got the '06 thing, and now here we got Janet Yellen, and it's interesting because these things always seem to happen, and there seems to be an attitude. They should call it practicing to be the Fed chairman, because Greenspan used to make up all kinds of words. Bernanke was not as creative as Greenspan. He had the wealth index. Everybody's like, where's it at? No one could find the wealth index. Never was revealed, but Greenspan seemed to be hanging on to it. And it's like, what was that? I heard a comment about Tesla's doing a gigaplant. And this analyst was on, he goes, I think they made that up. Because there isn't anything. So now he goes, all the media is, the gigaplant. So they're pretty, this is how the world works, and especially in the world of social, I guess, of all of our social networks that we have out there. So let's move on. I want to take a look at junk. And we're down to the last 5 minutes, man. We have just really had fun today. I'll have to admit. So junk, I did not do the numbers that were on the junk, but you can see it is also rolling over, and it's actually breaking through the moving averages here. So that has happened. So let's summarize, because we really got into there's a lot of details. Maybe we need to do a 2-hour show today, just because there's so much that's going on. And so we'll take a look. We're really, if I can get back to the right chart here, we're still holding these lows. We're acting like we're going to get a rebound into the close today. Whether it can get flat or positive, we'll see. If it fails, around the numbers on the commentary have a 1925 25.50. If we get through that number on the upside, then we could recover further and maybe get back to the 1930 level, which would be an unchanged number. But 1925.50 is going to be the key number. If we probably don't get above that by, let's say by maybe 2 o'clock New York time, it's probably not going to happen. So we'll see what happens there. We're 2110. The lows have been on this chart. Just trying to get to the low here. The low is 1637, so we're about 500 points off. And I think the market will get a little tired by the time we get to that level. So, Mitch, should I cover most of the stuff we talked about, or was there anything?
Yeah, I think so. I mean, we'll certainly have more to discuss, I'm sure, on Monday.
I would tune in on Monday as well, folks, because the opportunity that the markets are creating here, and I believe that's the case. For us VPM folks, I wouldn't be surprised to see a pretty decent run with the daily being where it's at and being down at 20. That means a lot of patterns broke down yesterday, and just looking at how a lot of the indices are set, we could see some liquidation here. And we didn't really touch on some of the other indexes that I was hoping to touch on. But I'm going to put IJR up here real quick before we sign out. Get a couple minutes. This pattern I wanted to bring up. I'm glad this is a monthly chart, but this thing is forming a giant top here. We went up on last month and made a new high, and also had a key reversal. We came within, if I recall, bring this up real quick. Last month's low was 105.99. June's low was 105.99. Yes, we did. 105.86 was the low, and that was the close for the month. So we had an outside reversal bar from the previous month. We actually made a new high. Everything happened. This is probably, and I've been saying this for weeks, that maybe the small caps kind of led us up. This whole leverage thing I'm talking about, maybe they're going to lead us down when this thing turns over. And this is probably the most significant pattern that's out there. So those of you who have small caps in your portfolios, you probably have already seen some liquidation, and you probably have a fair amount of cash in that strategy. My guess is you'll have a little bit more on Monday. We'll see what kind of run we get on tonight. So on Monday morning we'll be covering that for sure. So, but that pretty much summarizes. I think I got a lot of stuff I wanted to talk about. As far as what to do right now, I would say if you're not a VPM user, probably should be if you're on air. But you want to have a good strategy to do this, and we've already been starting to protect a lot of these assets as it stands. So we're looking at probably a significant move. I'm going to be really surprised if we don't see several thousand sales tonight.
I think you're right on that. I pulled up a couple of quick stats in regards to the global equity strategy. I know a lot of advisors are currently used that or have used it in the past. Right now on the Global Equity 4, which is sort of our favorite of the global equity strategies, that's 60% invested. That's only owning the domestic market. We don't have any exposure to the international. The Global Equity 1, which is the original portfolio, still has that position in EM, which is positive. But on the daily, as we already talked about, that's completely out. Yeah. So it'll be interesting to see going into this weekend with tonight's run.
That was the infamous ETFDI, as it was called once upon a time.
Yeah, and we'll be talking about that a little bit on Monday as well.
Yeah,
talking about the impacts, especially on EEM.
And those strategies in a 3-year mode are up way over 35%. So, from 2012 forward, it's absolutely participated incredibly well. And now that we're getting some protection, I'm excited for this next cycle. If this thing does roll down, we should start to see some real dynamics come out of our system. So we are. It's time. It's Friday. I guess those of you are in the right areas, you can go play golf. I think it's going to be 109 here today. It's a little late. You got to get up about 5 in the morning here in Scottsdale to play golf. So anyway, have a great weekend. Tune in on Monday, because it's going to be an opportunity to digest the close of today and everything that's happened, both in the month of July as well as how we're starting off August. So have a great weekend, folks, and we shall talk to you soon. Take care.